This podcast is brought to you by Pragmatic Solutions, the leading iGaming PAM platform with a modular approach, including many benefits like a fast, secure, and scalable API-based platform, integrated with all major third-party products and services. Make sure you head over to Pragmatic Solutions and join our smart thinking.
Martin, as I mentioned here just before, I did a little bit of a deep dive in GIG's history here recently, and I just want to say, like, a couple of years ago, almost exactly 3 years ago today, the share price was at the bottom. You had a market cap of that time at around 20 million euro, and the business was hanging in the balance to some extent. Since then, the business have gone just from strength to strength to strength to strength. And today you have a market cap of around 250 million euro, a 10 doubling of the low point 3 years ago. So I wanted to start off by asking today, 3 years ago today, when you woke up in the morning, how did you feel?
Well, it's funny, I was only a year into being at gig. So, you know, it takes a little bit of time to get to understand the true scenario within an organisation. 12 months is probably a good place to be. In that initial 12-month period, I certainly saw and was involved in a lot of discussions about how we had to rescue the situation, because the fact of the matter is that we had a bond that needed to be repaid. It's just a simple fact. There's no getting away from it. However, I think that from Q3 2019 onwards, there was definitely a very, very specific focus about the leadership within the organisation. We were keen to strip back against all the different revenue streams that we had within the organisation, and we really, really wanted to focus. I suppose the decision at that time was, will we focus on B2C or will we focus on B2B? We looked at all the numbers, we looked at the growth that we could achieve, we looked at the opportunity within the market, and we believed, and we still continue to believe, that B2B is really where the opportunity was. And I think if you take, when I woke up that morning, I was still comfortable. I genuinely was. The steps that we were taking in order to divest the B2C side. I think the guys that did that did a fantastic job. We were in a difficult situation, which was public, and that doesn't make it easy to negotiate. But they did a great job and took us on a trajectory that's got us to where we are today. So that's really the starting point. The starting point always is the lowest ebb, right? Yeah. And then you take that, you decide how you're going to action against it and take control of the challenges and take it forward. And there's been no looking back since then. Don't get me wrong, we're still in a challenging market. Yeah. Right, we're still in a place where we want to achieve more and have a bigger market cap and deliver more shareholder value. But when you look back and you look at what's been achieved, it's been a fantastic job by everybody within the organisation. And again, I'll go back to the leadership team, the focus, the focus vision in order to take the organisation where it had to go has been phenomenal. It's been great, and to be part of that and to help action some of those decisions and be involved in some of those decisions has been a great experience for me. I've loved every minute of it.
Yeah, I can imagine, and I can also imagine, you know, going through those times when the business financially wasn't doing well, and obviously it was losing money for quite a number of consecutive quarters. I would imagine that the business became very bootstrapped at that time. And now, as we go, I'm looking at the Q4 2022 report here, with, you know, you reporting all-time high numbers on pretty much every single metric that you can look at here, and the business is generating cash again. It must be a bit of a interesting transition that the business is going through now, perhaps from being very bootstrapped into becoming a profitable business again, with all that brings. I mean, you did just see the acquisition of Us Gamblers, and you know, it's you're building again. Like, can you feel that transition too, or?
Yeah, we made an acquisition on the platform side of the business with Sportnco last year as well. I think what's really important here to understand is that whether you're facing challenges or whether the sun's shining, you need to have a balance in your approach. There's a a saying that everybody will have heard, that make hay while the sun shines. And although there's an element of truth to that and you need to take advantage, there needs to be balance in how you approach things. And I think that's exactly the same situation when things are bad and things are being found difficult. So what do I mean by that? That if back in 2020, when we entered this situation, what we realised is that we had to cut costs, we had to cut back, we had to be more efficient as an organisation, and we had to increase revenue at the same time. Now, that's not an easy task, to be able to simultaneously deliver both of those elements. And what we managed to do with a data-driven approach was actually, in some cases, be able to invest in a situation that we know that would deliver more revenue and more efficiency across the organisation. The maturing process within gig over the last 3 years has been incredible. You know, I look back again and I think about some of the things that happened maybe in 2019, and some of the strategic directions that we took prior to all of this happening. And then I look at us now, and there's more people involved, there's more data, there's more consideration, there's more expertise. And whether it's a challenge or whether it's an opportunity, you still need to have that same approach. And I think that's where we've got as an organisation. And that base of decision making is at the core of the success that we've had.
Yeah, it's interesting. And I mean, at that time as well, when you chose to divest the B2C part of the business, it was also a lot of voices that were saying that divesting the B2C was a mistake. And actually, that was probably what the business should have focused on at that time. And obviously, as you mentioned yourself, like being in the negotiation side when the other side has leverage on your negotiation, knowing that you have to divest this part, it resulted in quite low in a quite low multiple on that business, of course, coupled with the fact that regulation was really tough at that time as well. And did you ever, like internally in the business at that time, was there ever really a consideration whether to divest B2C or B2B, or was that always like a pretty straightforward decision?
I think the simple answer to that question is if you look at what had to be paid back and what the value of all the other businesses were, then B2C was the obvious answer in terms of being able to get that cash to pay it off and to be able to sustain the organisation. But if you put that to the side, from my perspective, the fact of the matter is that if it had been possible, then either decision is right or wrong. Now, I'm a B2B guy. I've always worked on the B2B side. So if we decided to go down the B2C line, I probably wouldn't have been in the organisation anymore, in all honesty. But it's not about the decision, it's about how you action against that decision and how you embrace it and how you drive it forward. We still have somewhere in the region of maybe 60, 70 people who worked on the B2C side of our organisation, and they deliver managed services on behalf of some of our customers. And when I look at those guys, and they've had to make a transition as well, because even though they're delivering B2C and they're working on a brand and they're doing what they did day to day previously, it's still delivering on behalf of a customer. Yes. So this transition had to happen regardless. Yeah. So in answer to your question, Pierre, I think that we made the decision we had to. Yep. And it was probably, in all honesty, the only option. We had to uncomplicate our organisation. So if we'd had B2C, the brands, and we'd had media, would that have as many synergies as media and platform? I'm not sure. I always claim when I'm speaking to customers that we have a bit of an unfair advantage, because when we start looking at business plans and potential CPAs and different performance metrics, I can see that through the media side of our organisation, because they're driving traffic in the majority of markets where we operate as a platform. So that was a big sort of unfair advantage that we could take advantage of. Now, there's definite unfair advantages between media and B2C, but I think that synergy in itself was it really helped us as an organisation come together and work towards our goals.
Yeah. And I want to go into that too. So essentially, after the divestment of B2C, you became an organization that had a media arm and a platform arm, so to say. So it's kind of two arms of the company. Now, recently, you announced that the intention is to split the business in two. So essentially, you'll have two publicly traded companies, one which is the media and one which is taking care of the platform services. So that's also, like, when you navigated through these years after the divestment of B2C, was it a bit weird spot for the business as well to have these two different arms in the company that, from the outside at least, didn't seem to have that many synergies between them? Or is there more behind kind of the
Well, I mentioned the obvious unfair advantage.
Right.
You know, we are speaking to people who are going to operate in markets that we have data on and we understand intimately through the actions that we have on the media side. But put that to the side. Let's think about it just from a solely business perspective. You have a media arm that generates revenue relatively quickly in comparison to a platform business, which is a slower burner in terms of actually generating the revenue.
Right.
So, like, for example, I always use this example when I'm speaking to the media guys, but in theory, they could walk into a room with an operator, close a deal there and then, and have it up and live the next day. Now, obviously, it takes a little bit longer than that.
Yeah.
But on the platform side, the average sales cycle is 6 months plus. So it's a much different model. And actually, the two models complement one another. Platform builds, exponentially as you add more customers to it and you
Right.
get scale.
Right.
Whereas the media side of it, it does do that to a degree, but it does it much faster.
Right.
I suppose the two dependencies are different as well. Media has a dependency on Google, and the algorithm from
Right.
Google, and that's something that you can't control. Whereas on the platform side, it's very much tech-based. So, and you do actually have control of that. So again, it's a different dynamic,
Right.
and it moves at a different pace, but they actually complement one another. And what you'll see over the last 3 years is that media has obviously contributed a lot of cash, but platform has grown significantly. Year on year from 2019, it's significantly grown. We're now, I think it's 300%, 400% in terms of revenue ahead of where we were in 2019. But what people forget, because you look back and everybody goes, why was it so little? We were moving away from the white label model and moving into
PAM. Yes.
Exactly, into the own licensed operators, etc. So that was a transition in itself happening at the time.
So that was a transition in the transition.
Exactly.
Let's say, of the business. Yeah.
We wanted to move away from the liability of the white label model.
Right.
And
that increased the risk profile of the company, basically, because it was something, maybe you can explain it better than me, but in the white label model, essentially, a lot of risk in the business was based on what your customers were, like what marketing activities they were conducting. You were liable for their decisions, essentially.
Absolutely. Everything that they did publicly on their front end, in terms of marketing, in terms of anything that touched the customer, could directly impact us because we are the license holder. So we decided we wanted to move away from that and make sure that all licenses were on the side of the operator.
Right.
We're basically a SaaS solution now. We're not a white label operator at all.
Yeah, interesting. So now we come to the point then that the decision is taken within the business to split the two arms into two separate entities. Can you talk about why that decision was taken?
Well, I spoke about maturity earlier in terms of how from 2020, when we initially made the decision to divest B2C and move towards being a B2B organisation. And then we spoke about how the obvious synergies in terms of cash generation, fast, quick cash generation from the media side. And then on the platform side, you grow exponentially, but a little bit slower because of regulation of technology, of delivery. It's all a little bit slower. But we've got to that point now whereby media is obviously generating a lot of cash. You can see that in the report. There's no question about it. They're doing a great job, and they've been in a position we've been in a position, obviously, to make acquisitions recently, which I think we'll touch upon at some point. But if you look at the platform side, you might look at it and you might go, well, actually, you know what, is that ready to take that step? But the fact of the matter is that last year we signed 20 new customers at Gig, and some of them are already live, but many of them are still in the pipe. We know what that revenue is going to look like, right? So as a consequence of understanding that and being in a really strong position in terms of generating cash from the platform side, it made absolute sense to split them off and deliver more shareholder value. There was no question about that. But we've got to that point now where we can really drive that value, and that's what we've been working at for the last 3 years. So this was no surprise. It was always inevitable that this was going to happen. You know, if you looked at it and you thought otherwise, then I would maybe question your business acumen, right?
Yeah.
It just made sense. It made perfect sense.
Yeah, exactly. There were even a few little leaks that happened there a year or so ago as well on that side as well. So it was not unexpected for sure.
Yeah, we shan't talk about that one.
Fair enough. So essentially, a strategic review has now been put in place to understand how to split one company into two, essentially. So there must be a lot of different considerations here when you go upon such a mission. I suppose that Richard Brown, your CEO, has to choose one side or the other. There has to be another CEO that comes into place to the other part. Then you split two businesses. Do you need a new office? Like where can you talk a little bit where you are in the strategic review, and what are like the complications of doing something like this, perhaps?
Okay, so we're right at the very start. It's obvious from a business perspective this is the right thing to do, but in terms of the micro decisions, let's call them that.
Yeah.
I don't mean they're small. I mean that they're in terms of the macro element, they're small, right?
Yeah.
So in terms of the micro decisions, all of these things need to be made. But I want to go back to my previous point again about where we are in terms of maturity. So this is a data-driven process. We make decisions on the basis of what is right for the organisation. We've made this decision to split. Okay, and what we'll do is we'll analyse every single element, every decision that needs to be made. We'll look at the pros and the cons, and we'll decide from there what the right thing to do is.
Right.
So in terms of who's going to be CEO of either business, we don't know yet.
Or even like the names of the business. Like, will you keep the Gig name for both businesses or one of them, and then that's totally new brand for the other? Or
absolutely, it really depends. You need to look at the impact, and we'll sit down and we'll look at the impact. So if media have Gig Media and we have Gig Platform, what if somebody rebrands, what's the impact on their organisation? What's their impact on revenue potential? Could it be a good thing to get away from the Gig brand? These are the things that we need to take into account and make a decision on. So all of these elements are on the table at the minute and have to be considered. And
there isn't any set timeline for this, or?
I think we said that we would have everything ironed out by Christmas.
It's a year process, basically.
Yes, exactly.
Yeah, I mean, it's a huge undertaking to split a business in two. I would just imagine, at least,
Absolutely, and imagine all the data points and everything you need to consider before you make that decision. So, but the key focus is, again, delivering shareholder value. So that will be the key element.
Yeah, fair enough. I want to ask you as well, obviously, Martin, you are the Director of Sales and Business Development on the platform side of the business, and I understand that the operation of the business is somewhat split in two when it comes to the media and platform. But I'm really curious to know a little bit more on the acquisition of us gamblers on the media side of things. It was kind of funny in a way that a couple of years ago you divested the B2C part to a fairly low multiple at that time, and with the success of the business, now you were able to acquire a business at a fairly low multiple. I believe Us Gamblers was acquired at something around 4 times the EBITDA, which was actually similar to the divestment of the B2C brand of around 4 times EBITDA as well a couple of years ago. But I want to ask kind of like what was the business sense in acquiring Us Gamblers? Catena Media, obviously, who sold it, decided they want to focus more on the North American market, so they publicly announced that they are divesting Us Gamblers, their flagship brand. At the same time, I understand you can't comment on this specifically, but the rumors were that the AskGamblers brand weren't doing great financially. That they were that year over year the revenues were lowered. But what was the business sense for GiG to pick up this brand, and what's the kind of idea behind the acquisition?
Okay, so you're right. I mean, in terms of down and dirty data, I can't really help you because I wasn't involved in the process whatsoever.
Yep.
But what I can say is that knowing the guys on the media side of our organisation, they definitely saw an opportunity here.
Yep.
There's no question about that. I said earlier that from a sales perspective, the complexity of a media sale is very different to a platform, and I stand by that. But the actual business itself is equally as complex in terms of the strategy and how to deliver it and how to deliver value across all of your domains and your sites and everything that you have. There's a massive complexity to it. And I've never worked with a group of guys who are so passionate and knowledgeable about what they're trying to deliver. I mean, I spoke about laser focus earlier, but these guys are on a different level. They really are. The focus that they have on their KPIs is incredible.
Yeah.
So I would say that they definitely saw an opportunity here, and maybe some gaps in terms of what we deliver from the media side already, what we already had within the portfolio. And they definitely see the ability to positively impact the business that already exists.
Yeah, fair enough. And going back a bit in time as well, obviously you acquired Sportnco on the platform side recently, which is perhaps then closer to your day-to-day work. Can you talk now in hindsight as well, like how that acquisition happened? Has it been successful? Has it turned out the way you wanted to? Mm-hmm. What are the results of this acquisition that you did?
So it's funny, just 3 weeks ago I was in Madrid for an integration workshop. So we've had 2 or 3 of these over the last year. By integration, you know, it sounds very technical when you say integration, but it's from a cultural perspective as well. Okay. Yeah. You know, the Sportnco guys are a French business, and they had Technalis that they had purchased prior to us purchasing them, and they're a Spanish business. So we've taken a lot of steps in order to be able to integrate our culturally, our processes, our outlook. Again, the maturity element comes into it as well, and you need to work in order to get onto the same page about how you approach things and how you analyse things and how you come to decisions. But I mean, from my perspective, what Sportnco allowed us to do was deliver a true platform experience end to end. And there's not very many of those already existing within the industry. So if you look at the majority of combinations within the US, for example, it tends to be a PAM and a sportsbook combo. So that's 2 different types of technology that are working together. That means that the customer most likely has 2 different user interfaces that they need to interact with. What we can do as a consequence of buying Sportnco is deliver a seamless experience for the actual operator, so that they don't feel that there's a massive difference between jumping from the PAM and the sportsbook component. And that's a real advantage for us, for sure. So we, as a consequence of having that, we've definitely had opportunities come to us that probably wouldn't have done previously. And when we did this deal, I was very, very vocal about the fact that I saw it as a massive positive step.
Right.
And from a commercial perspective, there's definitely nothing that changes my mind about that.
Right.
We have a great team of, I mean, GiG. We had GiG Sports, but we had very little sports expertise within the organisation. We were a traditional, prior to the divestiture, B2C casino business. That's what we did. That's what, if you look at the brands that we created, Risk and Guts, etc., they're renowned for being great casino experiences. We maybe didn't have that experience on the sports side to the degree that we would have liked. So bringing these guys in, dealing with trading teams that are really experienced, that deliver 17% margin in a complex, highly taxed market like France. The ability to do that is unbelievable. So, and I love sports myself. and the ability to be able to have a conversation with somebody about the rugby or the football or anything like that.
That was, be truthful now, that was the main reason behind the acquisition.
Absolutely.
Right? So you can have some more friends to talk sports to in the office.
Absolutely. Unfortunately, Pierre, France beat Scotland at the weekend in the rugby. So
well, okay, back to square one.
Yeah, exactly.
Maybe you need to sell the business. Anyway, you mentioned North America briefly there earlier as well. What's the how does GiG view the North American opportunity? Now the dust is kind of settling on the market somewhat. It's turning out to be almost a duopoly, the North American market, between DraftKings and FanDuel, who together own 75% of the sports betting GGR in the month of December. There's another two operators that are accumulating a decent amount of GGR, but then you have something like 60, 70 operators that are like fighting for the rest, for the crumbles, essentially. So I'm getting ahead of myself here a bit. How does DRG look at the North American opportunity? And then perhaps can you talk a little bit more to this like very strange landscape in the North American market?
Okay, well, the US market is definitely a challenge. There's no question about it. But as I said earlier, again, at GiG, we really like to embrace challenges. I think you need to be calculated about it, and you need to be data-driven about it and understand exactly where the opportunity lies. But yeah, you mentioned the word duopoly. I'm not sure I would call it a duopoly yet, but for sure the data definitely looks towards that. But there's definite opportunity in some states, I believe, for other sportsbooks. I'll talk about one of our partners that's imminently going to go live. We are working with a brand that's going to be called Crab Sports in Maryland. And these guys, I don't know if you're aware, but the crab is the national animal of Maryland.
I didn't know that, actually.
Yeah. If you go to Baltimore,
I learned something new today. Thank you for that.
If you go to Baltimore, there's loads of crab boats.
Crabs everywhere.
Yeah, right. Exactly. And they have these crab shacks. Okay. It's like SpongeBob SquarePants, right?
Yeah, there we go. Yes, Patrick. Yes.
Yeah. So in these type of localized scenarios, I think there's definitely opportunity for organizations and brands to really personalize their approach to the customer, and I think that will reap growth for sure. I don't think that these guys will have the level of bonus spend and marketing spend that the DraftKings and your FanDuels have. MGM have come out publicly and said that they're going to reduce the amount of spend that they have in this. I saw their report the other day. And yeah, it makes sense why they're doing that, right? It makes perfect sense. So in terms of sports, I think the localized and the tribal element where you can personalize, and there's obviously a negative sentiment towards FanDuel and DraftKings from some of the tribes, certainly in California, from the conversations that I've had. So there's an opportunity there from that perspective. I'll come back to that in terms of proprietary technology in a second, because I think that's important as well, right? But then you have the casino element as well. Now, iCasino is live in 6 states in the US, and every time I see a new state putting a bill in, it seems to be shut down before it's even started. Like we saw Indiana the other day. Right. Maryland's also put in an iCasino bill. There's various others. New York as well, exactly right. But what I see here is I'll go back to maturity as well. I think this is going to be my mantra for the rest of the podcast. Yep. But maturity is really, really important here. When you look at how the lobby is approaching the scenario, it seems to me that we need to be a little bit more corporate about our approach and actually show the true benefits to the state in having this offering for their population. A lot of people say it's obvious, it's tax revenue, but actually you're going to be competing directly against the state lottery, who delivers a lot of revenue already. Now, is that going to cannibalise that revenue, or is it going to be on top of that revenue? And I don't think this is a question that's been answered. If they're doing scratch cards, will somebody go online and play a slot instead of buying a scratch card? This is the question that we need to answer, because it's the state lotteries, particularly in Indiana, it seems, that are blocking this and are very much against this scenario.
Right.
So therefore, we need to look at it from their perspective. We need to turn it round a little bit and say, do you know what? Actually, I can see it from their perspective. If I was in that situation, what would I accept? And that's how we need to approach it, because iCasino, everybody admits it, is a massive opportunity in the States, but if we're only 6 states and now we are 5-6 years into the project, it's not got the level of growth that the majority of people anticipated.
No.
And I wonder as well that in terms of multiples of value, whether that's actually impacting some of the duopoly and their overall valuations.
Right.
You know, by not opening up more states to iCasino. So, yeah, I think that's I think that's another consideration. But coming back to proprietary technology,
yes.
I think it's really interesting that cash has become more expensive. Okay, there's no question. Cash has become more expensive. So therefore, any organisation, forget about iGaming, forget about sports betting, any organisation has to consider their position when they're investing. And I think that given the current scenario, the way that they go about doing that has to vastly change. We've seen a few players in the States in particular go and buy sportsbooks, and it's not worked out the way they intended. In fact, again, I think it was just this morning I saw the Bally's CEO talk about BetWorks and the issue that they've had with that investment.
Yeah, they talked publicly about that was a mistake, more or less.
Absolutely, and listen, this is what's important is that tech takes time. Even if you're building it from scratch, it takes time to get it where you want, particularly in an unharmonised, regulated scenario. You know, if you're in the States and you're in 20 states, that's 20 different scenarios you need to deliver. So to get to a point where each of them are competitive, it takes a lot of time and a lot of investment. And the ROI on it, I would imagine that particularly US investors are looking for a quicker ROI,
right.
You know, because it takes a lot of time. So what does that mean for gig? That means that there's actually an opportunity for gig. I think that the industry or the economy works in cycles. It's not as obvious as I would like it to be, so I could explain this. But the fact of the matter is that if you look back to 2017, 2018, there was lots of sports books, independent third-party sports books doing deals with big players. And then what happened is that they had a cash surplus or a massive investment, or they did a SPAC, or they did something in order to generate revenue, which isn't possible now. And then they decided to buy their own sports book. I think Penn is the perfect example of that, right? And they decided to go and have entirely their own stack. But there's several examples of that. It's not just Penn. There's several examples of where they decided to go down their own proprietary technology.
DraftKings, good example.
DraftKings as well. That's a very good one. But I think we're back to that point in the cycle where actually organisations need to look at third parties before they even start considering that. And the fact that we are very, very committed to regulated markets, both from a PAM and a sportsbook perspective, actually puts us at a bit of an advantage. Some people would suggest to me that the opportunity in the US is decreasing, whereas I would actually say it's increasing. And that depends upon perception, absolutely, there's no question about it. But I think that it makes sense to invest with a third party, somebody like Gig, at the moment, opposed to putting a big risk and a lot of pressure on your organisation by either purchasing and then developing or developing from scratch your own technology stack. So I think there's an opportunity there for sure.
Yeah, that's interesting what you're saying. And I suppose a lot of software providers during the 2020, 2021 and maybe 2022 period, I suppose we're quite nervous of the trends that were taking place here with vertical integration becoming more and more the norm. But I get the feeling as well that this trend is kind of turning a bit now. As you mentioned here, access to capital is a lot more difficult in a world where the interest rates are 5.5% and investors aren't that hungry for investments right now. They are hungry to see companies that are becoming more lean and cost efficient and slimmer and so on, and obviously working with third parties would be a way to go down that route, and I would assume that this is what investors are looking for right now.
Well, you can get an instant solution to your problem. Like one of our target areas is tier ones who are looking to expand. Okay, so you might have somebody who's very specific to a particular market or region, but they have brand equity outside of that region and they want to operate there. But the technology is maybe is a little bit older, or they don't have the capacity in order to deliver a new market, or the knowledge, because, as I say, the regulatory framework isn't harmonised. So they look at somebody like us, a B2B platform that can deliver full end-to-end scenario and give them a quick fix in order to grow their revenue. And that's the point. Now, in 3-4 years' time, I can't comment what the climate will be. I can't. Okay, we might end up at a situation where they decide they want to build their own or they want to invest. That's different. But at this point, there's a definite opportunity there to be able to bring quick value to these guys, right, and give them the opportunity to get their ROI much quicker than they could do if they built their own.
Right. So traditionally, Gig has predominantly approached, say, tier 3, tier 2 operators in size that definitely will not go down the route of building or acquiring their own technology. Whereas you're saying now that there is actually an opportunity to approach tier 1 operators to try to sell these services. I suppose that this is a fairly new sentiment, as in a couple of years ago it would have been a lot more difficult to go down that route with this old approach of vertical integration. Is that are you seeing a change here? Is that what you think?
No, I don't think it's necessarily a change. I think it's a change in options for the tier 1.
Yeah, I
think that's the key, right? So I don't think that some tier ones would have looked at it 2-3 years ago and seen a different solution. Because then the reason that I say that is that ultimately the regulatory frameworks are what impacts these organisations in terms of to deliver from a technology perspective. So it's the appetite in order to take a step into that world and be able to deliver it, and probably have some unknowns about how long it's going to take. So that framework, that regulatory unharmonised approach has probably been prominent since 2018, 2019, where every potential jurisdiction has been regulating one way or another. So I think that was definitely, they looked at it and they were like, okay, do we do that ourselves or do we do that with a third party? But what I'm saying now is that they look at it and they want a quicker return on investment, and this is maybe a more prominent option for them. Yeah. But I'm sure that some will continue to do it themselves because they want control. But I just think it's for us, it's a definite opportunity.
Yeah, interesting. And looking at now 2023, just kind of the macroeconomic situation that the world is in, where there's like two sentiments at play right now, that maybe we'll head towards a soft landing in the economy and everything will be fairly okay, or actually we are just behind the door from potentially a deep recession. The latest inflation numbers that came out from the US definitely seem to spur on the second thesis that we are not out of we are not clear yet, so to say. Has this impact like your clients anything yet? The high interest rates, the inflation rates, people having less discretionary spending power and stuff like that, or do you not see any of those effects as of yet?
I think if you look at our customer base, particularly the more established customer base, they continue to grow, and particularly within regulated markets. So is the growth itself as a number, is it the same as it was 4 or 5 years ago? Absolutely not, because regulated markets are tougher to grow in, takes more investment. We reckon that in order to deliver the same sort of NGR on a monthly basis, you need to invest a third more into marketing in order to deliver the same within a regulated market. So obviously the ROI is less than it would be, and I think that's just a given. I think everybody's aware of that. So that maybe has seen that has definitely had an impact, and marketing has had to increase in order to see growth, no question about it. But you have to be clever. Again, I go back to, we're not an operator, all right? We are a platform provider, and we assist a lot of our customers in order to be able to grow. We give them options. We're constantly trying to add solutions to our platform. We're agnostic in terms of a platform. So if something new comes to the market that we think can drive value, then we'll deliver that on behalf of our customers. We try to be proactive in that manner. But as you can see, over the last 2019 until the end of 2022 there, where we just saw the Q4 results, the overall base is continuing to grow. So yes, it's tough. Yes, you have to be clever. I think that the days of spending £1 and making 5, I think that's gone. Maybe in some markets, I'm not sure, but yeah, I think those days are gone. I think it's become really competitive. There's no question about it. So you need to have something unique. I always talk about 3 sort of main elements, Pierre, when we're talking to customers. So one is traffic. If you have traffic, then you can make a success of things. All right, significant traffic. One is brand. Okay, so if you have a brand equity, then you can take advantage of that, and conversions, for example, will definitely increase as a consequence. Like for retail to online, we've done a lot of retail to online. And then the third is obviously simple revenue and marketing spend. By revenue, I mean actual budget in order to be able to invest. So if you can build something from scratch, you need collateral behind you. There's no question about it. But those, for me, are the 3 key elements. If you have one of those, you've got a good chance of being a success.
Yeah. Another interesting development, let's say, within Gaming Innovation Group recently is the fact that, to some extent, the business has gone full circle. Now, your founder, Robin Erik Reed, obviously controversial around the 2019 time when the business was struggling. He was ousted from the business at that time. And now, 3 years later, Robin Reed has just made an investment in Gaming Innovation Group through his fund, Happy Hour, which is kind of like, you get a little bit of like Steve Jobs vibes. Even, the appearance of Robin is a little bit Steve Jobs-like self, I would say. How does it feel to have Robin back in the business, or like active? It must be a bit of a nostalgia trip.
Well, I think everybody appreciates that Robin's a bit of an icon within the industry. I don't think anybody would question that. He has built Gig up until 2019, which the growth, if you look back, again, nobody looks at that anymore, but the growth that Robin and the team achieved during that period was unparalleled, like going from 20 people in Taj Beach to Gig Beach and various other offices around Europe. So yeah, he's an icon, there's no question about it. And I know him to be, personally, a very astute business guy. So, and as does the majority of the industry. So when he turns around and he says that he's put an X amount of euros into Gig because he's really happy with the position that they're in, and he believes that it will continue to grow and be successful, then that's just a confidence booster, both internally, because it's an endorsement of what we're doing and making the right decisions, but both externally as well, because a lot of people, I mean, he put it on his Happy Hour Twitter from memory.
Yep.
And we've seen a slight upturn in terms of acquisition of the share at that time. So he has influence. He's an influencer, really, from that perspective, right? I'm not sure he would be happy hearing that. But
No, I'll tell you. Did you hear the story, Martin, of when Robin moved the markets of Light and Wonder?
Yes, I heard.
That was hilarious. We had to tell that story. So back in iGaming Next 2022, let's say 8 months ago, something like that, Robin made a prediction that Evolution would acquire Light and Wonder. And that day, the share price of Light and Wonder increased, or the share value of Light and Wonder increased by like, I don't know, like 500 million or something like that. You're like an enormous amount. And thanks to Robin's statements there. So yes, I can get behind that sentiment. He is definitely an influencer in this industry.
Although it never happened.
It never happened. Not yet.
Not yet.
Not yet. Yep. We have to get back to that the next year. So I give you next and follow up on this. But it's quite funny. And as you mentioned, the endorsement of having Robin Reed as an investor in the organization, because I mean, it cannot be understated how respected Robin is within the industry. He is seen as one of the smartest persons within the industry who is on top of the industry at large, certainly, but also on a granular level as well to understand where the opportunities are. Robin has made a couple of investments through Happy Hour that have all turned out to be like wildly successful. And so the fact that he decides that his next investment is within GIG is an absolute statement, and it's something that the company should be very proud of, obviously.
Absolutely.
Yeah.
No, we're happy with that. We're happy with that endorsement. I mean, there's no question about it. It's great
Absolutely.
for us.
So Martin, now we're going to start running off a little bit, but looking forward now into the future, obviously the business is now becoming more focused on the platform side. When you go through the strategic review, eventually the platform business will be its own publicly traded company. What are your goals for the future now? What's the ambitions with this company? Where do you want to go with this?
Okay, so the goals don't change. This is why the decision to split the businesses in order to drive shareholder value was so obvious. Because the fact of the matter is that the goals that we're working to from the platform perspective are still exactly the same as they were 6 months ago. We have short, medium, and term goals to hit, and long-term goals to hit. So those still remain exactly the same from a platform perspective. Yes, we had some departments within the organisation that worked across both, but 85-90% of the personnel were working on specific platform or specific media goals. So they don't change at all. We're still working towards delivering those 20 customers that we signed up last year, making sure that they're generating revenue on the platform, continuing to target the types of customers that we're looking at. We spoke about the tier ones, we spoke about retail to online, any sort of traditional online business that want to target regulated markets. These are our 3 key verticals from a customer perspective. So we continue to target them. Delivery is obviously a very important element, which if you'd spoken to me 18 months ago, delivery is always important, but it's vitally important now, because when we bring in a customer, we need to fulfill our promises, fulfill what we've committed to. So that is a really important factor for sure. But we always knew that was going to be the case. So it's not a case of the Eye of Sauron moving entirely. It's not moving entirely. It's staying where it is, and it's focusing on the goals that we've already set. So it doesn't change.
I like the analogy, Martin. So essentially, you're not looking to reinvent the wheel. You have a strategy that works, and you're continuing to build on this strategy, perhaps becoming more operationally streamlined as well. I saw in the report that you are aiming towards, this is for the full business, I suppose, but you're aiming towards a profit margin of like 50%, an EBITDA margin of 50%, which is incredible EBITDA margin if you manage to succeed with that. I don't know if that translates over to the platform side.
That's a combination of both, for sure.
Yeah, exactly. Mm-hmm. But it seems to be that the idea is essentially the strategy works, continue to build on the strategy, improve over time, and not make any major transformations or major directional changes in the business. Just continue to do what you do.
Absolutely. I mean, there's an acronym that we use a lot within the organisation. It's KISS. Now, a lot of people like it to be KIS. I like it actually to be KISS. And it's keep it simple, stupid. So this is you can be in these situations and you can complicate the life out of the scenario. The fact of the matter is we're on a positive trajectory. We have been since 2019. We've made a lot of changes. We spoke about the white labels. We spoke about having own licensed operators. We spoke about the managed services. It's complicated enough without us making it any more complicated. So it's about keeping it simple. It's about being obvious to everybody what we do. It's really important that that's the case, because I think in the past, and I know from specific data that was compiled, is that a lot of people didn't know what gig did. Because we did have a studio at one point, we did do B2C, we did have this, we did have that, and we definitely had a very storytelling type of marketing. which in a growth period definitely works, right? I totally advocate that, but we're at a different period of the maturity of the organisation now, so we need to strip it back and keep it simple, and that's definitely what we're doing.
Absolutely. It seems to be that GIG is a business with a lot of scar tissue that has grown through the challenges that it's had, and again, going back to your point of finding maturity in the business. So just again, congratulations to the success recently. It comes obviously from a lot of hard and focused work.
And listen, it's not just, it's the entire team, and I want to really hit that home. It's really important that everybody acknowledges the part that they've had to play in this over the last 3 or 4 years. It's been a big it's a big movement of an organisation, and we've done it, and we're really, really proud of what we've achieved. So everybody should, at GIG or previously of GIG, should give themselves a pat on the back.
Yeah, absolutely. Martin, it's been a pleasure once again to have you here on the podcast. And I forgot to mention this in the beginning, but you are one of the OGs, one of the originals here on the podcast. This is not the first time we do this together, and certainly not the last, I hope. But thank you so much for giving me your time today.
No, thanks for having me, Pierre. All the best.
Thank you.
Cheers.